India's newest fund house, Zerodha AMC, which is a passive-only fund, has gone on to launch two new mutual fund schemes. Now, these are called Zerodha Nifty 100 ETF or ZN100, which is a large cap scheme, as well as Zerodha Nifty Midcap 150 ETF or ZM150, which is a mid-cap fund. Now, both these schemes are exchange-traded funds or ETFs, and that means that they will only be available to buy and sell on the stock exchanges. So what's different about these schemes, and more importantly, should you be investing in them? I'll bring you all those details, but before that, don't forget to subscribe to Moneycontrol's YouTube channel for more such content. Now, being a new fund house, Zerodha can still boast of assets under management or AUMs of 1,236 crore rupees on a monthly average. And when it was launched back in November of 2023, Zerodha Fund House had a tax saver index fund as well as a large and mid-cap fund. It then went on to launch a liquid ETF as well as a gold ETF. So now these two new funds are simply a pair of basic funds that sit quite well with the larger plan of Zerodha's, that is of creating a fund of funds. Now, if you are someone who tracks mutual funds quite closely, you would be wondering, why is Zerodha entering an already crowded market? And when I say crowded, let me tell you, there are about 91 large cap passive funds in the market currently, whereas for mid cap passive funds, there are close to 16 different schemes. So let's look at what would and would not work for these schemes then. One would have to keep a close eye out for the expense ratio that ZN100 as well as ZM150 would charge in the months and years ahead. The average expense ratio for a large cap oriented passive fund, be it an index fund or an ETF, is somewhere around 0.40%, with some ETFs going as low as 0.03 or even 0.04%. So since both the ZN100 and the ZM150 are ETFs, their expense ratios are expected to be on the lower side. Another reason is the fact that these are simple funds, which are good for any first-time investor that is looking to cut into mutual funds. The fact is also that they are passive funds, means that there is no fund manager risk, and that the portfolios are pretty transparent and you would only see volatility depending on market reactions to the index. But what doesn't work in the favor of these funds is that since they are ETFs only, it would mean that you would need a demat account in order to trade, and you won't be able to invest in them through a systematic investment plan or an SIP. Another disadvantage would be that if you want to trade in large quantities, liquidity could be a problem. But given the fact that Zerodha is an established name, they would have placed enough markers to address a liquidity concern. So if you are interested in these new funds, you should hurry, because the new fund offer or NFO is set to close on June 7th. If you like such content, keep watching Moneycontrol.com.